We constantly guess what the future will look like, but we rarely ask how it will be funded. Let's run the numbers. Longer lives can create institutional strain alongside private opportunity. The important distinction is between something being imaginable and something being financeable. A working capability does not automatically create buyers, acceptable risk, or a durable path to repayment. This is not a prediction. It is a conditional economic scenario built on one premise: retirement and insurance promises last longer, while contributions, premiums, and retirement ages do not automatically adjust. Change that premise, and the result changes. The first hidden assumption concerns timing. Resources must be committed before the system demonstrates its value, so delay changes both the cost of waiting and the attractiveness of alternatives. The second assumption concerns distribution. Across workers, retirees, pension sponsors, insurers, investors, and public institutions, the party funding the system may not be the party that captures its largest eventual benefit. So the question for this episode is who gains or loses when contracts are built on different longevity assumptions. We will follow scarcity, incentives, risk transfer, and institutional design rather than treating possibility as destiny. Now, the binding constraint is accurate duration estimates and the ability to redesign long-term obligations. That constraint is less visible than the technology, yet it determines whether the scenario can move beyond demonstration. The scarce resource is future contributions and investment returns available to support longer payment periods. When that resource is redirected here, it cannot simultaneously support many competing projects, service, or household priority. Allocation therefore creates an opportunity cost. A decision to support this scenario is also a decision to delay, shrink, or reject another use of the same resources. It comes down to scarcity. The headline idea may sound abundant, but the system still depends on limited capital, limited attention, limited coordination, or limited institutional tolerance for risk. Risk matters because contracts divide uncertainty unevenly. One side may receive predictable payments, while another absorbs delays, cost overruns, weak demand, or a failed assumption. The stakes are not simply whether the scenario exists. They concern who pays during the uncertain phase, who gains once the system works, and who bears adjustment if it does not. Start with fungibility. Resources that can move between uses give decision makers flexibility, while resources tied to a narrow purpose protect that purpose but reduce adaptation. Price and value are also different. A resource may be expensive because it is scarce, yet its strategic value depends on what alternatives exist and who can actually use it. Time changes the comparison. A benefit arriving far later must compete with nearer opportunities, and uncertainty compounds because both demand and technology can change during the wait. Institutions matter because they convert expectations into rules. Funding terms, eligibility, ownership, and repayment conditions decide which risks can be shifted and which remain concentrated. Under this assumption, the scenario begins with retirement and insurance promises last longer, while contributions, premiums, and retirement ages do not automatically adjust. That condition is analytical scaffolding, not evidence that the future will follow this path. Supply alone cannot settle the outcome. Demand must be credible, accessible, and strong enough to support the costs created by production, coordination, and risk. Distribution then changes political and commercial durability. Older contracts may favor participants, while younger contributors or sponsors absorb more of the adjustment, so the arrangement can remain unstable even when total output appears beneficial. With those distinctions established, we can trace the mechanism. The goal is to identify the sequence linking an initial assumption to financing, behavior, and the eventual equilibrium. First, longer payment periods raise the resources required behind each fixed promise. This changes the relative appeal of committing resources now rather than preserving flexibility for other opportunities. Second, contracts priced with outdated assumptions transfer value toward whichever side understood the duration risk better. The contract therefore determines who is protected from uncertainty and who must be compensated for accepting it. Third, institutions can reprice new promises more easily than they can rewrite existing ones. The original value proposition can weaken even while the underlying capability improves. Here is the constraint: individuals need dependable retirement income, while institutions need rules that remain solvent under changing lifespans. Each side waits for reassurance that the other side cannot credibly provide without moving first. That creates a feedback loop. Weak commitment raises perceived risk, higher risk raises required compensation, and more expensive terms make commitment even harder. This pressure remains even when participants share the same objective. Coordination can be solved through contracts, public backstops, shared ownership, or staged investment, but each method reallocates risk rather than making uncertainty disappear. The cost is redistributed rather than erased. Market depth also matters. A system with only a narrow set of buyers or providers is vulnerable because one change in participation can alter the entire bargaining balance. Contracts can reduce uncertainty by specifying obligations, yet they cannot specify the full range of future conditions. Flexibility protects adaptation, while rigidity protects expectations. Neither is free. Follow the incentive structure. Participants respond not to the broad social promise, but to the rewards, penalties, exit options, and information embedded in the arrangement. A major competitive pressure comes from later retirement, adjustable benefits, higher contributions, or shared longevity risk. If that route improves faster or costs less, the original scenario loses bargaining power. Timing now becomes strategic. Early commitment can secure position and learning, but waiting can reveal better information and prevent capital from being trapped in a weak design. Bargaining power follows dependence. The side with more alternatives can demand better terms, while the side facing a narrow path must accept more risk or surrender more value. Risk transfer has limits. Moving uncertainty onto another participant usually requires payment, collateral, control rights, or a public guarantee that shifts exposure elsewhere. Someone still carries the remaining exposure. Path dependence can then emerge. Once infrastructure, contracts, and expectations accumulate around one design, changing direction becomes costly even when a better arrangement later appears. The full mechanism is therefore a chain. Assumptions shape scarcity, scarcity shapes bargaining, bargaining shapes contracts, and contracts shape which version of the scenario can persist. Now test the first counterpoint. Automatic adjustment rules spread the response across contribution rates, retirement timing, and benefit levels. That arrangement produces a different equilibrium because profitability is no longer the only decision rules. The thesis also weakens if institutions remain unable or unwilling to update contracts as longevity information improves. In that case, the central bottleneck may shrink, move, or become substantially less binding. A rational exception exists as well. Flexible plans can absorb longer lives without crisis, when benefits and contributions adjust transparently. This shows why broad claims about the whole scenario can hide smaller viable arrangements. The limitation is that this framework cannot determine the future from theory alone. Unknown technology, preferences, policy, and institutional learning can alter many major relationships. Consider a bounded hypothetical case. Two systems offer similar technical output, but one has committed buyers and flexible financing. The second can persist even with weaker engineering performance. There is also a distributional trade-off. Older contracts may favor participants, while younger contributors or sponsors absorb more of the adjustment. A stable total can still conceal a difficult transfer between groups. These boundaries matter because the goal is not to declare one outcome. It is to identify which assumptions must remain true for the central mechanism to dominate. The conditional answer is this: the profit opportunity comes from differences in assumptions, but lasting stability requires those differences to narrow through redesign. Technical capability matters, but it cannot substitute for a workable allocation of cost, risk, and reward. Interestingly, the strongest signal may not be a technical milestone. It may be a contract, funding commitment, adjustment rule, or buyer arrangement that makes uncertainty bearable. Several conditions control the result: lifespan change, contract flexibility, contribution growth, investment performance, retirement timing, and information quality. Change any one materially, and the equilibrium can move in a different direction. Those conditions are necessary inputs, not promises of success. A favorable combination can improve viability, while weak coordination or poor distribution can still undermine adoption. Viability still depends on execution. The likely winners are participants with flexible options, patient resources, and better information. The likely losers are those locked into obligations while others retain the ability to exit. Institutional design can improve resilience by sharing risk, staging commitments, and allowing transparent adjustment. Yet each safeguard changes incentives and may create a new cost elsewhere. Change the assumption, change the equilibrium. That phrase is more than caution. It is the practical method for separating a useful scenario from an unsupported forecast. A second-order consequence is that successful funding can reshape scarcity itself. New capacity may lower value, attract substitutes, or create dependence on the institutions that financed it. The opening mystery is now resolved. The central issue is not institutional denial. It is how slowly long-duration promises can adapt when the underlying horizon changes. The economic bottleneck sits between possibility and a self-sustaining arrangement. To test a scenario like this, begin by identifying the binding scarcity. Ask what remains limited after the technology, policy, or social premise is granted. Then trace the funding model. Identify who commits resources first, what return they require, how long they wait, and what happens if demand develops differently. Change one assumption and follow the new equilibrium. Alter the timing, substitute, ownership rule, or buyer commitment. Then observe which participant gains leverage. The comparison reveals where control accumulates. Compare centralized and decentralized arrangements. Central coordination may absorb large shared risk, while decentralized funding may preserve experimentation and limit a single point of failure. Separate technical feasibility from economic sustainability. A system can operate physically yet remain unable to finance maintenance, replacement, access, or the risks surrounding uncertain demand. Next, examine distribution. Ask who receives the benefit, who funds the transition, who carries downside, and whether those positions remain acceptable over time. That shift can alter bargaining power. Finally, watch where scarcity moves. Solving one constraint often increases the importance of another, shifting value toward whichever participant controls the new bottleneck. Visible assumptions make revision possible. The conclusion remains conditional. Stability depends on updating long-term promises as assumptions change. The framework becomes useful when its assumptions are visible enough to challenge, revise, and compare. That is the framework. Follow scarcity, funding, incentives, and distribution until the hidden constraint becomes visible. The future is just incentives at scale. See you tomorrow.